What's up, everybody? I'm Jaspreet Singh, and if you want to win in any economy, whether you're in a boom or a bust, you need to understand these 5 things. First, you have to understand how economic cycles work and the different ways that you can make money in different economic cycles, because there are different ways to make money when you are in a boom economy, and there are different ways to build wealth and make money when you are in a down bust, recession, crash economy. The second thing that you need to do is you need to understand how to be financially educated. I'll be talking about how to manage risk, different investing strategies. How do you actually know where to invest your money through your financial education? Third, you have to understand now how to be prepared, because even if you have all the right financial education, but you have no ability to take advantage of an opportunity because you have no money, well, there's nothing that you can do. This is where you have to be prepared. I'm going to talk about how you can do that. Fourth, you have to understand now, how do you actually take action and invest your money, because unfortunately many people are doing this wrong, and we've seen this happen time and time again. And then fifth, you have to understand their long-term investor mindset. You have to understand how to manage your investment, how to keep an eye on your investment, how to make sure that you made a good investment. These are the 5 things that I'm going to be talking about in this video, in this order. So let's start by talking about number 1. Our economy, along with pretty much every economy in the world, moves in cycles. They kind of move like this, where if you zoom out and you look at our economy or any economy over the last 100 years, what you'll see is that they have these boom and bust cycles, where over the long term, the economy grows on average. But then along the way, if you look a little bit closer, you'll see booms and busts and booms and busts and booms and busts. Now, sometimes you're going to have bigger booms and bigger busts than other times, like when the 2008 crash happened. That was a major bust in the economy. The economy saw a massive crash. The Great Depression was a massive crash. Sometimes you have smaller recessions, smaller busts, and so you have to understand, though, on average, this is what the economy looks like. We have these booms and busts. They happen because now that you understand this, you can start to master your psychology, because most people hear the word recession, or they hear the word economic slowdown, or they hear the word market crash, and they get anxiety. They freak out. They stress out because they're shocked. How could there be a recession? How could we see a market crash? How are these things possible? I thought everything was perfect. But if you just look at the history, you'll see that these things are a part of the economy, and there's nothing for you to be surprised about if you understand how the economic system works, because now, instead of being shocked by it, because the people who are shocked by it are also the ones who are hurt the most by it, and those are the people then who end up losing the most money. So now that you understand that, hey, these booms and busts happen in the economy, now it's, how do I capitalize on it? Because there are different ways to make money when you're up here in the economy, and there are different ways to make money when you're down here in the economy. Now, if we start with just the basics, many people think that the way that you make money is only by buying low and selling high. So if you buy here, sell here, well, you just made money, right? Well, that's one way that you make money, and it's a great way that you can make money if you can perfectly time the market. However, most people can't perfectly time the market. What ends up happening with a lot of people is they say, oh, I'm going to buy it at the bottom. They see the market going down, and then they see it go down more, and then they say, well, I think that the market's going to go down even more. I'm going to wait for a little bit more of a drop, and then I'm going to come in and buy. But then what happens is the market starts to go up, and then they say, oh, this is too expensive. I don't want to buy it right now. I'm going to wait for the market to drop even further. And then the market goes up, and now you say, oh, this is too expensive. This is a bubble. This is too late. I don't want to buy anything. And then it goes up even higher, and now you realize that you missed it. You missed a great buying opportunity, and now you're just sitting there twiddling your thumbs while other people who came in and bought, who didn't try to perfectly time the market, are making a ton of money. I have made the same mistake before. I started buying real estate after the 2008 crash, and I was in Michigan, where the economy was hit extremely hard, because the Michigan economy was super dependent upon the automotive companies, Ford, GM, and Chrysler. Well, GM went bankrupt, Chrysler went bankrupt, and Ford was on the verge of bankruptcy. So the real estate market in Michigan was decimated. And I mean that you saw properties selling for, in some instances, 90 to 92% off. And the first property that I bought was a small 1,000 square foot condo in a good area for $8 grand. That wasn't the down payment, that was the total price of the condo. I rented that condo out after I bought it for $600 a month, and I put in a few grand worth of repairs. So I made a great return. Now that condo that I bought had sold for right around 150 grand just a few years prior to me buying it. So I started buying properties when they were at dirt cheap, when they were at rock bottom. And I bought a few properties under $30,000. And then I started to see home prices start to go up. We started to see this happen. And I remember this vividly because I was looking at homes in great areas, great neighborhoods. And these homes were selling for now around $50,000. And remember, I was young then. Like I started buying real estate when I was 19. And so I didn't understand how the real estate market worked. I didn't have any mentors. I didn't have any guidance. I didn't have real estate family members. So this is me just trying to figure it out myself. And I remember looking at these $50,000 homes thinking, this is too much money. Who would pay 50 grand for this 4-bedroom, 2-bathroom home in a great neighborhood? And I didn't know anything else because this was the only thing that I was ever exposed to. This is the first time that I ever got any real financial education. So I started turning down homes because home prices started to go up and I was like, this is too much money. This is no way that this is going to be sustainable, that this is too expensive for a home. Well, those $50,000 homes are selling for $300,000 to $400,000 today. Maybe even a little bit more. And so now I'm kicking myself like, dang, I wish I just understood what was happening a little bit better. That way I could buy even more. Now, of course, I did take advantage of what was happening. I bought a handful of real estate during the bottom and I made a great return on all of these properties, but I learned that these types of booms and busts happen, and there are different ways that you can make money on the top, and there are different ways that you can make money on the bottom. Now, what some people think is the best way to make money at the top when you're in this type of top of the market is to short the market. Now, shorting the market means that you're betting against the market, and you make money now when your stock or your investment goes down. So if you buy something and it goes down, well, now you made a profit. That's how you make money with shorting. I am not a shorter, because that is too risky for me, because you can lose more than all the money you invested, because there's no limit to how much money you can lose. Because now you make money when your stock or investment goes down, but if it goes up, now you owe money. And it can go up to infinity, right? There's no cap to how high something can go. So there's no limit to how much money you can lose, which is why I don't short. I like to buy, which is just my investing strategy. But now there are different ways that you can buy at the top, and there's different ways that you can buy at the bottom. I like to call it a passive and an active strategy. I'm going to talk about this in number 2, but this is where you have to understand that the way that you invest is going to be a little bit different at the top and the bottom. But your strategy, your general strategy is not going to change. It's just the way that you execute your strategy, because the opportunities are going to be different here versus here. And this is where now you have to understand a little bit how the economic cycles work. That way now you can take advantage of this, but this requires you to be educated on how do you actually invest your money. Let me first talk on a general level, then I'll get a little bit more specific on how do you actually invest your money. So on a general level, when it comes to investing your money, there are 2 different ways that you can put your money to work. You have fundamental versus technical. Technical is your traders. These are the people that are looking at stock charts, they're looking at stock candles, and they're trying to get in and out of an investment or a stock quickly. So these are your home flippers. These are your stock traders. People that don't want to hold on to an investment for the long term, they just want to buy it and sell it for a quick buck, whether it's in 2 days or a year and maybe some change. So it's like a year worth of holding something. You don't want to hold this for less than a year. You are a trader, and now you're looking at the technicals. I am not a trader. I am not a good trader. I did try trading for a little bit because it was exciting and it looked like it was really fun, and people kept talking about how much money they were making, and I tried it for 1 summer when I was in college, and it sucked so much time out of my life, and it sucked so much energy out of me because you're constantly glued to the screen trying to figure out how it works, and I realized I'm not a good trader. So I don't trade, I don't advocate trading, I talk about fundamental investing. Now, fundamental investing is now where you invest into an asset, something like a stock or real estate or whatever your investment is, and now you want to hold on to this for the long term because you believe in the underlying value of your investment, and you think that you can come in and buy it at a good price. That way now, as your investment continues to provide good value, they continue to get better, it continues to produce more. Now your investment will become more valuable, and maybe it's also paying you dividends or royalties or some sort of income along the way. And so now you're just holding on to your investment for a long term, and that's how you become wealthy through these fundamental investments. Now, if we dig a little bit deeper, within fundamental investing, there are two general ways that you can invest your money. You can invest your money actively, or you can invest your money passively. Now, let's start by talking about the passive investment, because passive investing is a little bit easier to understand than active investing. Passively investing is where you ignore the market cycles, you ignore what's going on in the economy, you find some good investments, and now every week or every 2 weeks or every month, you are just putting some of your money to work no matter what. No matter what's going on with the economy, whether the market is up or down, you are consistently passively and ideally automatically investing your money. So I do this type of passive investing, and I passively invest my money into 3 places. This is just what I do as an example. I'm not telling you what to do. I passively invest my money into the stock market, into cryptocurrency, and into physical gold. So the way that I do this in the stock market is I have some ETFs that I invest in. An ETF now is a group of companies. So it's not investing in one individual company. I'm investing into a basket, into a whole group of companies. Some of these are like the S&P 500. It's a group of the 500 biggest companies on the stock market. Some of these are companies, ETFs, that pay out a dividend, high dividends. Some of these are ETFs that are investing into emerging markets, countries like Brazil, China, India, Korea, countries that don't depend on the dollar and don't necessarily fully rely on the United States economy as some extra diversification. I also invest in some ETFs that give me exposure to technology and innovation because I like this. So I have picked these ETFs, and now every week I have money that's automatically pulled out of my checking account and deposited into these ETFs. This happens here and here. It does not matter where in the market cycle that we are. I'm just letting my money constantly, actively, passively, and automatically be invested. So that's how I do it in the stock market. Then when it comes to cryptocurrency, I'm investing my money daily into some cryptocurrencies that I believe in. Now, if you don't believe in cryptocurrency, if you don't like cryptocurrency, don't invest your money in cryptocurrency. It's something that I believe in because I like the technology. But what I do is I have a couple cryptocurrencies that I like to own, and I buy a little bit of them every single day. Again, passive, automatic, and it's consistent. Third, I buy physical gold. Now, the way that I buy physical gold is also passively, where now once a month, I have money that's leaving my checking account and it's automatically buying me a little bit of physical gold every single month. Now, if you want to see how to do this, I have listed some of the apps that I use down in the description. You can check them out. Most of them are affiliate links, meaning you will get compensated if you use them, but you can do your research. If you like something better, that's fine. I'm just letting you know what I'm using. That's how you passively invest your money. Now, actively gets a little bit more involved now. This is where now you're not just automatically investing your money. Now you're paying attention to where you are in this market cycle, but you're also paying attention to the individual investment. So an easy example for me to give you when it comes to an active investment would be to talk about real estate, because I am a real estate investor. And so now when it comes to me investing my money in real estate actively, I am looking for a good real estate deal. That means I have my own criteria. I want a 7% cash on cash return on my money. So if a real estate investment requires me to put in $100,000 worth of cash into the deal, I want to make sure that I'm getting $7,000 worth of profit every year for owning the property. If a deal is not giving me $7,000 worth of profit, I'm not going to be interested. So I create these types of rules, and I'm looking for deals that meet my criteria, including a good location, it has the right type of property, it has the right type of field. There's a lot of different things that I look for in the actual real estate deal, but when it comes to the financials, I want a 7% cash on cash return. Well, when we're in this type of market cycle, at the top, it becomes much harder for me to find this type of 7% return. Is it impossible? No, but it's become much harder. When we're at the bottom, finding this type of 7% return isn't as hard. And so the number of deals that I can find is much better. I can find even better returns, and I can find more deals. So now when it comes to me actively investing my money, I'm going to probably be actively investing more down here in the bottom half than I am up here. Does that mean that I'm not investing up here? No. I just need to make sure that it's still a good deal, that I'm still getting the returns that I want, but I have to be a little bit more picky, and I got to do more research. It's the same thing in the stock market. Now, when you find a good company that you want to invest in, you got to do the research. What type of company is it? Are their revenues growing? Are their profits growing? Are they creating a good product? Do they have a good executive structure? If you find a good company, you make a list of companies that you like. Now what you're looking for is a good buying point. Now there's two things that can affect the buying point. One can be the external economy, and second could be what's internally happening at the company. Because now you can have a great company that's doing really well, that's growing their profits, but the economy is tanking. And if you have a great company in a tanking economy, well, you might see the stock price fall, not because of what's happening at the company, but because of what's happening with the economy. This can create a great buying point for you because now you're getting a discount just because of what's happening in the economy. Likewise, a company could be on the verge of a turnaround, but the market hasn't seen it yet. So now you could be at the top of the market. The company is not doing great, but you're seeing it start to turn around. Well, now this could be another buying point for you because now the price is lower, not because of what's happening in the economy, but because of what's happening internally at the company. So this requires an extra level of financial education where now you're digging deep into how do you actually invest your money, and now you're looking into this active investing. Now, where is it that you want to invest? Because you have to be educated in your investment style. And what I mean by that is that you're actually learning how do you invest your money in this asset class. So the major asset classes would be things like stocks, real estate, cryptocurrency, physical gold, startups, investing in your own business. These are the places where now you can invest your money. I just talked about the different ways that you can actively invest, but now you have to get educated on how you actually do it. We have a ton of videos on my channel you can check out. We have a free ebook on passive investing, which if you haven't read yet, I recommend that you read it, where it's a guide on how do you start investing your money, how do you start generating passive income, even if you don't have any money or if you don't have a lot of money, even if you have just $100 to invest. It'll give you some guidance on how you can start investing. If you want to read my passive investing guide, I'll link it for you, how you can download it for free down in the description below. But then you can also go a little bit deeper. Then you can start reading books about things that you're interested in. Read books in real estate investing, stock market investing. And then if you want to learn more, you can even go out and purchase classes. But the best thing that you can do, the best thing that you can do if you want to learn how to be a good investor is to actually invest and get the experience. Because experience is the best teacher because you're going to make mistakes. And some of these mistakes you can't read about in books. I made a video on my channel about my worst real estate deal ever. I'll also link it for you down in the description. But in this video, I walked you through my worst real estate deal ever. I walked through every mistake that I made. It was a painful process, but the number of lessons I learned from that one deal set me up to do so many bigger deals. But it was a painful process, and those were things that I could not find in books. No matter how many real estate classes or books I took, you're not going to find that information because some of these things that you learn from experience, you can't get anywhere else, so you cannot replace that experience. Third, now if you want to take advantage of these types of active investments, you have to be prepared. And the way that you're prepared is you just got to have cash. You need money to be able to capitalize on these investments, or you need access to capital. So how do you do that? Well, the way that you do that is you prepare when times are okay. So when you have an income and you don't have that many expenses, you need to be putting some cash aside. Now, there's a couple ways that you can do this. Obviously, you keep passively investing your money, but then you can also put a little bit of money every time you get paid aside for an investment fund, where now you're just waiting for a good active investment. And so the key here is to be prepared when times are okay, that we can take advantage of opportunities when times are not okay. So what do? Well, you can increase your income or you can decrease your expenses. When it comes to now decreasing your expenses, the first thing that you can do, which is the simplest, which doesn't require you to cut back on anything, is to call up all of your subscriptions. So your internet company, your cable company, all of these utilities that you have, just call them up and ask them for a discount. And the way that you do that is you just start looking at all the competitors, see how much money they're charging, and see if you're overpaying. Because sometimes what happens is you get stuck into an internet company or your cell phone company or whatever company, and you don't check your bill for a little while, you just keep paying it, but then they just keep raising your prices. And then the competitors start offering new introductory rates. And no company wants to lose a good paying customer to their competitor just because they're offering a lower price. So now what you can do is you be nice to the customer service agent and you say, hey, I noticed my bill is now $110. I used to be paying $75 a month. Is there anything that you can do? Let them see if they will bring you the bill down. And then you can say, well, I see that your competitor is also charging $55 a month. Is there any way that you can match that? I don't want to leave, but it's a pretty big price difference and I might have to leave if you can't match the price. Now, if they match the price, well, now you just saved a whole bunch of money on your bill and you didn't have to change anything. You didn't have to downsize, you didn't have to change, you just got a cheaper price. The second thing that you can do to find some extra cash is just sell some of the stuff that you're not using. Every single person has stuff around them that's collecting dust, that doesn't do anything. And so if you have a bunch of junk around you in your home, in your apartment, in your storage, well, maybe you can just sell some of it and turn this dust into cash, and now you have some cash that you can use to take advantage of opportunities through this active style. Now, the next thing is obviously you can increase your income, and there's a lot of different ways you can do this. You can start a side hustle, you can try to start your own business, you can look for another job. And so if you now are increasing your income, the key is you don't just increase your lifestyle to match your increased income, because now you have no more extra cash being put aside to take advantage of opportunities. So the key here is to create a margin where you're spending less than what you're earning. That way you have cash put aside for your investments. You need cash for your emergency savings. You want to have cash for your regular spending, but then you also want to have cash put aside to take advantage of investment opportunities that might come your way. Fourth, this is where you have to actually take action. Now, one of the things that you can do here is understand how to manage your risk, because one of the things most people are scared of when it comes to taking action is what happens if I lose money? Well, the first thing is now you manage your risk. And the best way to manage your risk is by getting educated, because the more educated you are, the less risk you take. But this is where now you want to take calculated risks. We're not just throwing your money into meme coins or into meme stocks, hoping that you can double your money in 30 days. This is where now understanding that you want to be an investor, where you're doing more fundamental investing, where now you're researching your company, you're researching your investment, because the more research you do, the more you can limit your risk. And this is the same when it comes to stock market investing or real estate investing or cryptocurrency investing. The more research you do, the more educated you will be. But this is where also you have to understand that there is a chance that you will lose money, because investing is risky. You're never guaranteed to make money when you invest. You might even lose money, which is why you should always do your own research and never blindly listen to a random guy on YouTube. Now, when it comes to now investing your money, if you don't want to feel scared of losing your money, think of your invested money as lost money. That's one of the easiest things to do, where if you take $1,000 and you invest it, think of that money as gone. Because if you're trying to stare at your stock market portfolio every single day, it's going to cause anxiety, it's going to cause stress, it's going to make you panic when things go down, it's going to get you excited when things go up. And when you are an investor, you don't need to get so excited and emotional when it comes to investing your money, because that short-term richness is loud, but wealth is whispered. And so now if you want to become wealthy, you don't want to be constantly keeping up with their investment. The way that you want to do it now is just be researching the companies or investments that you made and make sure that it's a good investment, and then letting time run its course. If you don't want to get into all that stress now, you just invest your money, think of it as gone, and now you just check it once in a while to make sure that you're still investing in good companies. But understand that investing has risks, and the way that you mitigate those risks is by learning. That way you can manage your investments the right way. Everybody's always trying to time the market. Everybody's thinking, oh my God, the market's going down. Should I wait for it to go down more? I think the market's gonna collapse. I don't want to start investing now. Or they say, oh, the market's at the top. Why would I want to buy now? You're gonna lose money. Everything's gonna bust. But nobody can perfectly time the market, and the people who try to time the market miss out on all the opportunities. And this is where now, instead of trying to perfectly time the market, what you want to do is create your own strategy, create your own rules, and then when you find a good investment that fits your rules and your strategy, it fits your investment criteria, make the investment, because you're going to learn the most by doing it. And if you just sit on the sidelines, not only do you not get any of the action, you don't get any of the upside, and you don't get any of the learning. So it makes sense for you to go out and invest. And if you're still scared, start with a smaller amount. You don't have to start by investing all your money. Start with a little bit. That way you can start to get the feel of it, get a taste of it. That way you can at least get started, because as soon as you have some skin in the game, as soon as you put some of your own money into the game, that's when you're going to learn the most. And this brings me to number 5, which is investing your money for the long term. And the reason why this is so important is because if you are a fundamental long-term investor, timing the market doesn't become so important. Because now let's assume that a little while ago, you made a mistake. You bought at the top of the market. Although you bought a good investment, you bought at the top of the market, and as soon as you bought, things went down. Well, what could happen if you buy a good investment is, well, you bought it at the top, right here. As soon as you bought, things crashed, and now you see your investment get cut in half. Now you feel very sad. But then things start to rebound, and then they go up, and then they go down, they go up, and now you look, after a few economic cycles, you see where you are. and you're a lot higher now than you were before. Even in the next boom or bust that you see, your bust is still higher than where you bought when you were at the top. And so this is where now it's about not just trying to time the market, but time in the market. This is one of those things that Warren Buffett keeps talking about, where everyone's trying to perfectly time the market. But instead of trying to time the market, have a good investment that you find at a good price, meaning it fits your investment criteria. And even if you buy at the top, understand that if you're a long-term investor and it's a good investment, that things will continue to rise. You still have a lot of upside ahead of you. This is why you want to have that mindset of understanding that you're not a trader, because traders think very differently than fundamental investors. Traders are thinking about the next 12 months. Fundamental investors are thinking about the next 12 years. And so it's a very different mindset. And if you can pull yourself away from the emotions, you'll be able to reap the rewards, because traders can make a lot of money in the short term, but they can also lose a lot of money very quickly. Fundamental investors are the ones that make the most wealth, but it also takes the most time. But it requires you to be more patient and understand that if you have a good investment, you just got to give it time. And sometimes when you're just staring at the stock portfolio, it can be very anxiety driving, because you keep seeing your portfolio go down and down and down. But now this is where you just want to take a deep breath and understand, is it a good investment? Is it something that you want to own for the long term? If yes, then let the market do its thing, because the market can be very volatile and very wrong in the short term, but over the long term, it will eventually correct if it is a good investment. And over the long term, you will see the investments that are more valuable will grow in value, because investors will want to have the stronger, better investments, but it requires you to hold on to something for the long term.
There was a bunch of stuff going on, and we were packing up after the police got called, because it was just a very crazy event. And one of the DJ friends came running and he said, "Hey, somebody pulled a gun." Not at other people, but at the, he didn't pull it at the DJ person, but they kind of threatened a gun. And so he kind of came, and so we had to like put our stuff away and get out of there.